Hello, and welcome back to the Macro Gamer channel. My name is Mark Cassingham. Today we're going to get into week number 9 of our weekly numbers. This is going to be on Friday, September 20th, 2024. So let's get into the numbers. So first, as always, we have our portfolio's net worth. We're at $164.29. Again, as of September 20th. You see, you have our pie chart and our allocations. The larger pieces go towards gold and bonds. Those are two biggest allocations. We look at our portfolio weekly data. You see a drop here from the 18th to 19th. We did have a pivot in the Federal Reserve. So in the past couple of years, we've raised interest rates up to about like 5.5%. And for the first time, after holding it steady for a little while, it's now at down 0.5%. So there was a big volatile week. A lot of time was built up for this. People have been asking for rate cuts for a long time, even though the Fed has been raising. The Fed is trying to get their inflation target down to 2%. They haven't gotten it down 2%, but they've been like 2.5%, 3%, kind of getting close to where they want, depending on which metric that you use. So they're beginning to start rate cutting now. So that's where this dip is happening right here. There's a lot of volatility around Wednesday, Thursday. But for the week, we are up 0.98%. That is our money weighted return. So again, this is the return that we look for. We have no new net cash flow yet. Our starting value as of September 13th is $162.69. And at the end of September 20th, we're up $164.29 for a market gain of $1.60. So again, just a pivot with the Fed. There's a big market week for a lot of people, so it's highly volatile. We'll go over that a little bit more. Our monthly return. Our monthly return, we have a money weighted return of 2.75. Man, my language today, I apologize. A money weighted rate of return of 2.75%. We're up 2.75%. Remember, when you see these big stair steps right here, where it goes from down here to $130 range up to this $160 range, about every 3 weeks, the $10 per week I'm adding up exceeds the $25 minimum cash holding to be deposited into the account. So usually around $30, it gets deposited in. So this is the cash coming into the account. This isn't market performance. Market performance is down here, 2.75%. Going $130 to $160 is a lot more than 2.75%, right? But we're not counting that. This is performance weighted. So we have our net cash flow. This was around this time frame of $30. So we're going to cover this, every time we do a monthly or 3-month chart, you're going to see these stair steps. This is from August 20th, starting at $129.92. Ending in September 20th, $164.29. We had a market gain of $3.59, and we had a dividend earned of 46 cents. So not bad for the month. Like I said, volatility this week for sure. So we're going to look at our weekly portfolio percentages. We have gold up 1.49% for a gain of 74 cents. And gold is still at a 30% allocation in our portfolio. You're going to see when we do the charts, gold is just a fucking monster. It just keeps going up. It's incredible. That's why we have a 30%. Our highest theoretically would be 35%. I haven't took anything to 35%. I would prefer 30%, but that would be our absolute highest. So anytime you see something at 30%, that's basically saying this is as high as we're going to go for this allocation. So gold, been at 30% this whole time. It's been great. Treasury government bonds down 0.35% for a market loss of 17 cents. And again, we still have this at 30%. And remember, we increased our bonds position because we listened to what the Federal Reserve was saying when they signaled, I think it was in July, where they're going to potentially begin a market cutting cycle, decreasing rates. And as of this week, they held to their word and they dropped 50 basis points. If you prefer that term, I just say 0.5%. So we're going to see how that plays out over the next few months. I might be reducing this position. Maybe it doesn't play out how we want. We're going to change with the market. We're not going to go against the market. We're going to change with the market. The market is dynamic and our portfolio is going to be dynamic. We're going to follow it, right? We have our UUP ETF, which is our US dollar ETF, down 0.13%, 13% for a market loss of 3 cents. And we still have that at 15%. The dollar's probably going to keep going down, unfortunately. So this position, I don't know if I'm going to drop it 5% more or keep it at this for right now. But as of right now, we're going to see what happens with rate cuts. If rate cuts keep happening, it's going to weaken our currency, our US dollar. So we're going to see what happens. We might go into commodities. We'll see. Commodities, speaking of, are up. Our USDI index, our ETF, is up 2.48% for a market gain of 40 cents. And we still have this at a 10% allocation. Our RSP, which is our equal weight S&P 500 index, up 1.37% for a market gain of 22 cents. We still have that at a 10% allocation. And then arguably a big jump this week, Bitcoin, or the IBIT ETF, which we changed from the BITO ETF recently, is up 5.21% for a market gain of 44 cents. And we still have that at 5% allocation. Again, I could take more risk in increasing specifically these two stocks and Bitcoin, but given everything with, usually when the Federal Reserve lowers rates, that's kind of an admission of, there's things happening in the market that aren't typically good. Like when the Fed eases, they lower rate, they ease. That means they're trying to make it essentially easier for people lending and borrowing, right? Because the rate is a dictation of the market. Right, when they raise, they're trying to slow things down. When they lower, they're trying to speed things up. But I'm being like, this is a big overarching picture. Basically, I'm trying to paint right now. But usually, when you're cutting like this, it's not typically a good sign. We're going to see what happens. Every market environment is different. Every cutting cycle is different. Every raising cycle is different. We're going to see what happens. But for right now, I still don't have the conviction to raise my allocation of stocks and Bitcoin yet. If I felt it was a strong growth environment, then I would, because these are strong growth assets. But I don't think we're in a strong growth environment, so I have these lowered, or I have these reduced. I think we're in a strong risk off environment, so that's why I'm heavy into gold and bonds. That's kind of my thought process. So that was the weekly percentages. This is the monthly percentages. So gold up 4.74% for a market gain of $2.11. Good month for gold. Bonds up 1.08% for a market gain of 47 cents. US dollar down 35% for a market loss of 8 cents. Commodities up 3.06% for a market gain of 45 cents. Stocks up 3.43% for a market gain of 50 cents. And Bitcoin ETF, keep in mind that the IBIT was just added recently, so we don't really have a full month's return yet for this ETF, so just keep that in mind. Maybe there's about 3 weeks of this data. Once we get to next week, it should be a month's worth when we do the monthly chart. But it's up 8.96% for a market gain of 73 cents. So those are our monthly percentages, and of course all the allocations are the same. So no transactions this week in our stock portfolio. So that's the ROI, the return on investment for our stock portfolio. So now we go to the staking portfolio, or ILV. So currently we are at a ILV price of $41.24. This is as of today, like an hour ago. And we still have 2.11 ILV token in total staked for a market value of $87.11. We still have our vesting, which we have our first one at 1.32 ILV that we originally staked around the time of purchase. It was $100. It unlocks in 309 days. So remember, we lock it up for a full year. So when it first started, it was 365. So it unlocks in 309. We did this as of July 27th. And the weighting of 2 is because it's a full year, so we get double the rewards the longer we stake our money. And remember, staking is equivalent, we should put quotes, maybe choose a better word. It's similar to like a CD or certificate of deposit that you would get from a traditional bank, or if you lock up your money for a period of time, they give you a % return at the end of that time. So as an example, if I give them $100 and they lock it up in an account for 1 year, and they say at the end of that 1 year, we'll give you 5% on your money. So I lock up $100 for a whole year, which means I can't touch it for a whole year. And at the end of that year, they return to me my $100. So I get paid back in full my money. Plus they pay me 5%. So I'll get $5. So at the end of that 1 year, I'll make $105. So similar to this, I'm locking up my token for a full year. And in return, whenever the studio gets paid, I get a portion of the revenue. And we've had one payment so far. And then we have our second stake at 0.79, pardon me, 0.79 ILV. More recently locked up, so it'll lock in 337 days. It was locked on August 24th, I'm sorry. For a market weighting of 2. So again, same thing, we're gonna try to get double the rewards. And of this week, no revenue distribution, so we're at $0. And those are our weekly numbers. So next, of course, we're gonna go look at our charts. So again, gold, just this phenomenal uptrend that just is relentless. I'll take a little drink of this real quick. There we go. Phenomenal return, still at all-time highs. Look at this right here at the peak, right around here. All-time highs. All-time highs in gold. Gold is fucking relentless. Back here since October 2023, just been in a strong uptrend. It's incredible. We have no reason to reduce our position to gold. There's no trend break here. There's nothing wrong with this trend. And I can show on a chart later. I've posted this. Also, if you don't follow me on X, I have an account, Macro Gamer X. I'll show you on this video too, but I posted a picture of gold's returns year to date versus the S&P 500 returns year to date, and gold is beating the S&P 500 this year. So in the year 2024, if you had 100% of your allocation put in gold versus 100% of your allocation put in the S&P 500, you'd make more money if you had it in gold. That's how good gold is this year. This is a phenomenal uptrend. There's no reason why to get out of it. If things change, we will change. But as of right now, there's nothing wrong with this trend. It's beautiful. Gold is a fucking monster right now. It's kicking ass, and we're riding this thing. 30% of our allocation. Government bonds. So remember, we came into this wedge pattern here, and all these charts are 1 year charts. I should be saying that from the start. All these charts are 1 year charts. I like to look things long term, not short term. So this is a 1 year chart. So remember, we had this breakout of this wedge pattern, and then we had this strong uptrend. And guess what happened here on September 17th and 18th? Well, this was when the Fed announced a rate cut. So there's a little bit of volatility here. So it started coming down a little bit. Now, I don't know what's going to happen over the next few days, weeks, or months, but we're going to watch it. But so far, this uptrend out of here has been positive for our account. It's done very good. So ideally, I hope this trend continues upward. We'll see. But remember, if you look at bonds, really any bond, more than, I would say, 10 years, you look at this downtrend that's been happening since 2020, and they started raising rates afterwards. So I'm hoping, like I keep saying, we're at this bottoming area, and then we're going to start going up. So I would like to position heavy. If this trend is correct and it continues, I would like to position heavy into bonds and then just ride the trend up as long as they're cutting rates. And then when the rates are going down, remember they're inverse. So when they cut rates or rates go down, like your bond prices go up, or vice versa. If they're increasing rates prices, the bond's going to go down. Right. So right now we seem to have started a rate cutting cycle. Right. That's what happened on Wednesday when they cut by 50 basis points or 0.5%. So rate cutting. So ideally, bonds rising based on that. Right. We're going to see what happens though. We're going to watch. We're going to pay attention. We're going to adjust the portfolio accordingly. So we have our UUP, our US dollar ETF, again, also came into a similar wedge pattern, but then broke down. Still kind of come down, and then kind of gone sideways. Hasn't really shown it can go up. So depending on if cutting rates will reignite inflation, I might cut 5% out of this position. Currently it's at 15%. And I might move it to commodities again if inflation starts up again, and put more into commodities. But we're going to see what happens, right? We're going to see what happens. But right now, it came into this wedge pattern, it broke down, and we reduced our position. It's been coming down. So the dollar's been coming down. And again, as we cut rates, we are effectively weakening our currency. I'm speaking as an American, I should say that. The US dollar currency. As an American, you know, my purchasing power is getting cut down, right, by the government. But I have, you know, a large position in gold. You know, I'm fighting back against them cutting against the purchasing power of my dollar by investing in gold, right? That thing's been going up, right? So just a little investing philosophy there for you. So if you look at this is kind of what I'm talking about. So we have our commodities ETF. You had this uptrend here going back to December 23. And then we kind of hit this peak here in July 24 as we're coming down. But look at this strong uptrend right here happening in the month of September. So commodities are hitting a hard reverse and going up. Now it might hit this red line and come back down. I don't know. It might break out and keep going. I don't know, right? We're going to see what happens. But like I said, I would likely, if this trend continues, reduce my dollar position and increase my commodities position. Still, gold and bonds will probably be the same. We're going to see what happens. My glasses are fucking with me today. But we're going to see what happens with commodities. We're going to watch the market. Right, we're gonna do what the trend does. Right, we're not gonna go against it. We're gonna follow it. We're gonna adapt to it. Then we have our stocks ETF, our equal weight, still in the strong uptrend. Again, I'm being very cautious with stocks. I'm not adding more to it, even though this trend is really good. Again, that's my personal bias. I'm not 100% on the stock market. I don't think it's going to do well long term. Maybe in the next year or two, we'll see. But that's why I have my position at 10%. And also, the stock market stocks in general have more volatility than some of these other assets. Maybe not compared to commodities. Commodities are pretty volatile, but some of these other assets, you know, are volatile, and like stocks are very volatile. So I want to like keep my position reduced. And the last one is Bitcoin, which if you've been watching it, it's been coming in this downtrend. It kind of hit this peak back in March, and it's becoming down. And then after this rate cutting cycle, we kind of had a bit of a pop here, but kind of see it came to this red line and hasn't really broken above it yet. It might break up above it a little bit, like right here and right here, but like we don't know if it's going to stay consistent and keep going. All right, we're going to see what's happening. My guess is until the trend breaks, it's not going to break. I think it's going to keep going down. Again, until the trend breaks. Right? If the trend breaks, then I'm going to change my mind. I'm like, oh, look, the trend broke, and like it's going to keep going up. But due to Bitcoin's volatility, I don't know if I'm going to increase my position. Like again, I don't feel like we're in a strong economic environment, a growth environment specifically, where I have to invest more in Bitcoin. So we're going to keep it as is. Now, as I was saying earlier, if we take our gold position, let's do year to date, and let's make it a line to make it simple for everyone. And then let's overlay the S&P 500. So the S&P 500 is this reddish line, and then the gold is the blue line. Now, what do you notice? The blue line, coming all the way to the current date, which is right here, September 20th, is higher than the red line. The gold is up 27% year to date, and the stock market, sorry, let me phrase that, the S&P 500, shouldn't say stock market, the S&P 500 index, the largest index in the world, basically, is only up 20%. It's only up 20%. So all the people out there, and I know there's a lot of them that don't like gold or bash gold for whatever reason, well, gold's kicking their ass this year, right? If you're invested in the largest stock market index, which, you know, you could look at 401k funds, pension funds, hedge funds, big funds, a lot of them all pile into that S&P 500. You know, they would get a better return if they were in gold right now. Doesn't mean it's gonna be that way every year, but as at the very least, at the time of this filming, year 2024, September 20th, gold's kicking the S&P 500's ass by at least 7%, by about 7%. So gold's doing great. Gold's doing great. This is why, like I said, I'm not selling gold. The trend on gold's phenomenal. It's great. All right. Now let's see if my, oh man, if I can find my thing. Oh, probably gonna have to cut this out because I'm fucking up. Here we go. Fed funds rate. Does it update? Oh, I don't got the update on this. Well, that's a shame. Well, there's supposed to be a little bit of a drop right here because the Fed got dropped by 0.5, but basically we're about 5.3 and we dropped by 0.5%. So we're somewhere maybe between like, let's say 4.75 and 5. But if you look at it, go to all. If you look at it, let's see right here. Let's go back. This is 2000 to present. So about 24 years. Up in the early 2000s, we were way up here. Around 6.5, and we dropped, and it came back up. And this is, the Great Recession. We were raising, and then it dropped, and then of course, whenever this drops, you see like a recession. Same thing in 2001, you see a recession. And then here we were raising in 2019, and then obviously what happened in 2020, we all know, global pandemic. They dropped, and the market dropped with it. And now here we are, raised back up, and we're starting to drop again. So what people speculate on is we're going to drop again, and because we drop again, we're going to see a market crash. And we might even see an economic crash. And we might even see a global market crash where like other countries come down with us. We don't know yet. Like I said, the Fed just reduced 0.5% this week on Wednesday. So it just happened. It just happened. Everyone's hyping it up, but like it just happened. So we're going to see. We're going to watch it. But again, that's why I'm in my bond position. Government, GOVT. I believe, I really don't like lines, but I try to make it simple for people. I believe that if they will continue this cycle, rates are going to come down and bonds are going to come up. So we're going to see what happens. 50 basis points or 0.5%, people making such a big fuss over it. But we were raising like 25 to 50 basis points. I forget exactly, but every Fed meeting for like a year or two, right? We just kept going boom, 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 boom. So if they follow the same process, they might be lowering at a similar pace. Maybe by 0.5 each meeting. I don't know, but going down, down, down. There's been no emergency, in quotes, emergency rate cut yet. Usually that would happen if like the market crashes or something like that. But we're going to see what happens. My hope is we never go back to 0% interest rates ever again, because all that does is inflate assets and inflates inflation and everything. It makes it harder for people to purchase. I think we do need some sort of interest rate. We need to pay off debt, obviously. Maybe the Fed works in a 1% to 3% range. I don't know, right? I'm not smart enough to make that call. But 0 is unacceptable, and going from 0 to 5% in such a short amount of time when we haven't been at that height really like consistently over like at least 20 years, like I don't think it's a good idea. I think we got to come down, but not down to 0. So we'll see what happens. Like I said, if this bond thing doesn't work out, I would lower my bond position based on what I'm seeing right now. I would have to give in and like put something into either commodities or stocks, and I prefer not to, just because I'm less optimistic, but we'll see what happens. So as always, you can comment, subscribe, like, criticize, whatever. I'm going to keep making these videos, keep making updates, now people can follow along. So if you like to learn, if you like to pay attention to the market, if you like a kind of a macro strategy where you're combining multiple asset classes, not just stocks or not just crypto or not just gold or whatever, just multiple asset classes, that's what I'm trying to make a portfolio so people can follow along and learn. So hope you enjoyed it. If you have anything you want to let me know about, let me know. And have a good day.